Hello and welcome to another opportunity presented by Impact Self-Storage, where we provide access to tax-advantaged self-storage investments with an emphasis on wealth growth and downside risk mitigation. So let's go ahead and get started here. The agenda is going to be about 15-20 minutes, and we're going to cover the team, why now, and the big idea, the numbers in the secret sauce, the offering itself, and then we're going to see if we're a good fit for each other. So first, we have the team. We've done about $100 million in self-storage transactions in the last 3 years. We currently own 17 facilities across 9 states and have a combined 60 years experience amongst the 4 of us. We have 2 offices. The office in Chicago handles all the front-end items such as acquisition, sales, marketing, and investor relations. And the office in Des Moines handles all the back-end operations such as construction, finance, property management, and HR. So why now? Well, really comes down to there's 3 changing market forces, which is creating a short window of opportunity. So if we act now, we can catch this window and hopefully profit from it as well. The first is the changing economic forces that we're seeing. We all know that self-storage is recession resilient. Between 2007 and 2009, the S&P dropped 22%. And during that same time, self-storage only dropped about 3.8%. And according to TREP, a commercial mortgage-backed securities research firm, of the 1,700 CMBS loans that were made to self-storage investors in the first 3 quarters of the pandemic, only 3 were delinquent. That's a 0.17% delinquency rate. During that same time, multifamily was defaulting at a rate of 1,800% higher, or 18 times the default rate of self-storage. The second piece of this is that the stock market is overvalued and overleveraged. The last 2 times the stock market saw price earnings ratios this high with this level of investor leverage was right before the 2001 dot-com bust and the 2008 financial crisis. And the last piece is that interest rates are at all-time lows. For now, the Fed has already signaled a schedule of rising rates, and inflation is right around the corner. We've already seen the report that just recently came out showing CPI to be about 7%. If you backdate using the mechanics in 1980s for calculating CPI, you're actually closer to 10 to 15% inflation. So if you're sitting in cash, you're losing a lot of your wealth every day. The next piece is the changing technological forces that we're seeing. Customers, especially the younger generation, want to handle their storage needs online and with less human interaction. In addition to that, the technology itself is starting to evolve and becoming more and more financially feasible and streamlined. As you can see in the photo on the right here, that is what a tech-forward office looks like. It's unmanned. You can rent your unit, you can buy a lock, you can find the map of how to get to your unit. And if you have trouble with any of those pieces, you can click a button and go on a 2-way call with someone in our call center. That allows us to reduce our labor costs for management, save anywhere between $60,000 to $120,000 a year in management costs alone. And the last piece is the changing social forces that we're seeing. The pandemic has caused some pretty serious shifts in living situations. We saw this K-shaped recovery where the upper leg did pretty well. They started moving out of cities into nicer homes with more space for not only an office, but also potentially for kids to work and do school from home. Whereas the lower leg of that K-shaped recovery didn't do as well. They're facing evictions and foreclosures now that the relief has been expiring. In the end of the day, both of these groups are going to need storage. Anytime someone is in transition, that is a key customer for self-storage. And then demand is growing. 1 in 10 households use self-storage, and that has been rising year over year for the last 15 years. In addition to that, baby boomers are starting to downsize in mass, and that's leading to an increased use in storage. Something like 10 to 15,000 baby boomers are downsizing per day. Then on the opposite side of the generational divide, we have the millennials and the Gen Xers. They're opting for less square footage. They want to be in the middle of the action by all the restaurants, all the nighttime entertainment, and they're opting to get a 700 or 800 square foot apartment and using storage as an external closet. As you can see here, the self-storage has returned really well over the last 30 years or so. The S&P 500 has returned about 7.5%, whereas self-storage has returned about 17.43%, with multifamily lagging about 4% below that. Now, the 4% may not seem like a lot, but that's compounding over 30 years. So let's see what that looks like. If you had invested $100,000 into each of these asset classes, here's what it would look like. In the S&P 500, it would be about $500,000. If you put them into apartment buildings, you'd be at about $1.7 million in return. But if you put into self-storage, that 4% extra compounding interest, you'd be at a little over $4 million in total return. So over double the return that you would have gotten in multifamily over the last 30 years. So what is the big idea? Well, the big idea is to take this location here and to turn it into Class A REIT grade self-storage. So here's what it looks like. This is our project in Wilkes-Barre, Pennsylvania, right off of I-81. Very great traffic counts. So what we're going to do is we're going to tear down all these existing buildings except for the Dollar General. The Dollar General is going to be driving a lot of demand, a lot of eyes and vehicles to our site. So that's going to be a plus to have on there. And here's what the site plan looks like. You can see the Dollar General is up there where it says existing commercial building. And then you have the Class A multi-story build in front with drive-up units in the back. We also have the ability to expand in the future, depending on how the lease up goes. So a lot of optionality with this project. So like I said, it's in Wilkes-Barre. It's right outside of Scranton, Pennsylvania. It's about 2.5 hours from New York and Philly, and then about 4.5 hours from Pittsburgh. And like I said, you can see in the lower right photo, we're right on the I-81 exit ramp. So a lot of vehicles, a lot of cars, a lot of eyes on our project. Let's talk about the market demographics that are extremely favorable. First is in the 5 Mile trade area, we're seeing a pretty large population of 113,000 people. But the piece I want you to focus on is the ratio of rental housing units to total housing units. What we found is that renters typically use storage more often than permanent residents, and we like to see a pretty healthy percentage of that. And as you can see, about 20,000 of the 55,000 houses are rental housing units. Then again, we were talking about the generational demand. So as you can see here, about 11% are in the greatest generation, about 25% are in the boomers. So both of those are going to be driving a lot of demand for storage as they downsize, move into assisted living facilities, downsize from large empty nested houses down into condos and apartments. And then on the other side of the generational divide, you have the Gen Z and the millennials accounting for about 46% of the population here. These are going to be the types of people that opt for smaller square footage, closer to the action, where they can enjoy the nightlife. So who is a good fit for this investment? Well, it's pretty simple. Investors needing to double their money in 5 years or less, who are dissatisfied with volatile investments such as stocks, or are sitting on a lot of cash that's being eroded actively due to the inflation that we're going to be experiencing. The Wilkes-Barre self-storage offering is a product that is recession resilient in a market that is severely underserved. And I'll touch on that here in a second. And unlike most development projects, the Wilkes-Barre self-storage project allows for multiple exit strategies to mitigate against that downside risk. So what do I mean by multiple exit strategies? Well, let's look at the timeline here. There's a lot of buying pressure in the storage space right now. A lot of the REITs, a lot of the private equity firms are trying to get in on the action. They took a timeout during the pandemic, and now they're sitting on a ton of cash that they don't want to be eroded to inflation. They also don't want to deal with the supply chain issues and the construction headaches that we specialize in when it comes to building these Class A self-storage facilities. So what happens is right when we zone the land to self-storage, we already start receiving offers to sell the land at now this elevated value. And then once construction is done in about 14 months, now we have certificate of occupancy, and we've already seen private equity firms and REITs making us full 5-year stabilized valuation offers at certificate of occupancy. We actually just closed one of our Mokina self-storage developments where we built it for $10.5 million. And in 13 months, we sold it above our 5-year projections at $18 million to a private equity firm. And then again, once the project breaks even around month 27, then you start getting some of these aggregator funds coming in and making offers. And then again, once you're extremely cash flow positive after month 50, that's where you're going to start to see a lot of the big boys coming in and making full price offers if they aren't already been beat to the punch by some of these larger, more nimble private equity firms. So let's look at an overview of this project. The Wilkes-Barre development is a ground up development of a premier Class A storage in the area. It's going to be the best facility in the area. It's going to be about 85,000 net rentable square feet, which equates to about 718 units. It's going to have that interior loading and unloading. This is a premium service that we offer to our residents, especially in the Northeast, when in the winters, you can have 3 to 4 feet of snow. So this is going to be a differentiator for us compared to what's around in the area. We have really good visibility from the roadway. The curb cut is perfect. It has a lot of traffic. And then, like I touched on before, there's 388,000 net rentable feet in pent up demand that's unmet in this market. The way we found out about this was by hiring a third-party feasibility expert that is specialized in the self-storage space. And when the feasibility study came back, we were happy to see those numbers. Further supporting that unmet demand, we see that all competitors are at 90 to 100% occupancy. Typically in the self-storage space, if you're at 85% occupancy, you're considered completely stabilized or full. Anything above that means that you're not pushing rates high enough. So to see all these competitors at 90, 95, and 100% occupancy means that there's a ton of pent up demand, and there's also a lot of room to go on raising rates. Now, this is a super key item. Very rare to see this. We have 0 competitors in a 2-mile radius. That's extremely rare for what we typically do. So really good for us. And then it's surrounded by dense residential. That dense residential is what drives a lot of the business to the storage facility. Roughly 67%, 65 to 67% of our customer base are these residential tenants. They drive a majority of our business. And then, like I said before, it is off the ramp of I-81. So a ton of eyes, a ton of traffic, a lot of visibility, a lot of demand coming because of that. So let's cover the numbers. I'm going to try to keep it really high level. This is the part of the presentation that typically puts people to sleep. So I'm just going to go over things very quickly. And if you are excited about this project, you'll be able to get access to the investor portal and read through all of the fine-tooth due diligence items, the Excel documents, the financial modeling. You can spend as much time as you want on it. So like I said, these are high level. And if you want to move forward, just ask for access to that Invest Next investor portal, where we'll have all this documentation, including that feasibility study for you to review. So here's the deal numbers. We're getting a bank loan at about $8.4 million. Equity to purchase is going to be $1.5 million. Puts our total project cost at about $10 million, with a projected sale price at $17 million. Now that projected sale price is pretty conservative, and I'll show you why. So at stabilization, this thing is going to be kicking out $1.6 million in revenue. It's going to have an operating expense of about $530,000. Net operating income will be a little over $1 million a year, and the projected sale cap rate or valuation cap rate at a refinance event would be at 6.25 is what we're underwriting to. However, we've been selling other assets at much lower cap rates. We just sold like I said, a Class A facility at 0% occupancy at above our 5-year projected numbers. We just sold a portfolio of 10 properties at a 6.1% cap rate, and that 10 property portfolio was all Class C facilities in tertiary markets. They're all 20 and 30 years older than this new build. So here's what the cap rate matrix looks like. Like I said, we'd be targeting about a 6.25% exit at 17 million. However, I wouldn't be surprised if it started to creep up into this, the high 5s, maybe mid 5s. We can creep into that 18 to maybe $19 million valuation. So what is the secret sauce? Well, it's pretty simple. Number one, everything we do is tax advantage to reduce your annual tax burden. You can apply the depreciation and the losses against your passive income. If you happen to have real estate professional status, you may also apply that towards other income. We have multiple exit strategies to mitigate downside risk. We're always ready to sell in case of that perfect offer comes by. And then, of course, we want to make sure that you double your money in 5 years or less, and maybe 5 years at the max, and maybe 13 months like our previous project. So here's the official offering. You'll get 84 cents in depreciation for every dollar invested in the first year of operation, which would be for 2022. There's going to be a 10% preferred return going to the investors, which means the limited partners get paid first before the equity investors do. At this type of split, you'll get about a 22.6% targeted internal rate of return, which will equate to about a 2.13 times equity multiple on your money. So pretty good numbers. And here's just a quick matrix of what you're looking at in case you're deciding which level you want to come in at. So if you decide you have $100,000 that you want to invest, in the very first year, you're going to have that $84,000 tax offset. All distributions, including cash flow and sale or refinance proceeds, are going to be at about $213,000. So then we subtract that initial return of capital, that $100,000. That means that you're going to be making $113,000 profit on your $100,000 investment for a 2.13 times equity multiple. So, are we a good fit? This is really the most important part. There's a lot of capital floating around there. We just want to make sure that we're doing business with people that we like, know, and trust. So number one, do our core values align? Our core values are pretty simple. It's Fido, like the dog. F is for fun. I is for integrity. Do the things that you say you're going to do when you say you're going to do them, even if no one's looking. D is for drive. We're here to make sure that we're growing our investors' wealth. And O, which is the most important, is others first. Self-storage is a hyper localized business, and we want to make sure that we give back to the communities that are supporting our businesses. Number two, you have to be an accredited investor. It's the only way to participate in this deal. This is a 506 Charlie syndication. So you must be accredited. That means 200,000 or 300,000 annual income for the last 2 years, depending if you're single or married, or $1 million net worth, excluding your primary residence. The opportunity is short-lived in the market, so you're going to have to act fast. I'm going to need you to give me a decision in the next 10 days, and it's 100% totally okay to say no. I just need you to tell me yes or no, because I don't want to reserve spots for you in case you decide that you don't want to move forward. And that way I'm not reserving spots for someone else that can come in and actually fund. So next steps, you can email me to get access to the investor portal, perform all of your due diligence and seek advisors. Complete the subscription booklet, the W-9, and review wire instructions. And if you don't want to pay the wire fee, you can even connect your bank account to the InvestNext service. It goes to a third-party service. We don't see any of your financial information. That will allow you to ACH money to the account to secure your investment. And then on the back end, it allows us to distribute our distributions directly into your bank account without having to send checks and make sure that we got the right address, all of those things. And then, like I said, we're going to need you to wire funds in the next 10 days. We already have about 2/3 of this subscription filled. So I'm assuming the other third is going to be filling up here pretty soon. So if you have any questions, feel free to give me a call, shoot me a text, or shoot me an email. I'm around. You guys all have my contact information. And of course, we always need the disclaimer. Our attorneys would not be happy if I didn't put them in here. This is a 506C under Reg D syndication. So make sure to consult your advisors. So that is all I got for you guys. Really appreciate your time. I'll talk to you soon.